Hey guys, welcome back to my channel. Today we're going to go over Schedule M-1 Workpaper, also known as the Book to Tax Workpaper. Now this is a workpaper that is very common, especially those in the US corporate tax field. If you are a CPA candidate trying to study for reg, or you're someone who is trying to do their own US corporate tax, or if you're looking to go into the public accounting space in tax, this video is just for you. Now, the notes and all of the details with the spreadsheet is down below in the description box. And if you guys want to see more, don't forget to hit subscribe. So without further ado, let's get started with the video. So let's go ahead and take a look at what this Schedule M1 is. So this company name is called New Company Inc. This company is brand new. There's no prior year to reference. As you work at different clients, you'll know that not every client has prior year work papers to refer to. What the work paper is, and then we also write the year end of the tax period. So we always start with book income or loss, and that comes from the trial balance that the client provides us. Now, the formula goes book income plus or minus permanent differences or M1s, plus or minus temporary differences / M1s to get us to the taxable income / loss. What does that actually mean? So we're going to break this down. We know that books follow the GAAP principle, but as tax professionals, the GAAP is our starting point. And what we really need though is the taxable income. The taxable income is different from GAAP because we actually look at the IRC, also known as the Internal Revenue Code. So because of that, we have these differences in between to get us to our final number that we like to see on a tax return. We're just going to take a look at two M1s, one being a permanent M1 and one being temporary. So let's start off with the book income amount. So we're right here at $150,000. This amount of $150K is coming from your trial balance or your financial statements. Going down, we also see the permanent M1s. So the first one that I wanted to talk about is the political contributions. So as you guys know, political contributions for book purposes, it's deductible. So when you have a donation or contributions to a political organization, you are going to see that expense for book purposes and in your TB. However, when we're talking about the Internal Revenue Code for purposes of taxes, we see that the political contributions is not deductible. So you see that book says it's deductible of $1,000. Tax purposes, we're saying that zero. You don't get that deduction. So because of this, and usually this number is just coming straight from the TB, so you can usually see this amount in either the trial balance or the general ledger, and you'll see that this is a $1,000 add back. So you see where it says unfavorable. If you look at the formula, it says if the number in column B is greater than 0, then write unfavorable. If not, write favorable. So this is just a formula that I typically use. It just allows me to quickly see if it's unfavorable or favorable. Now, I've been at mid-tier accounting firms that didn't actually have this part of it where it says unfavorable, favorable, but for me, it was just a very helpful way to see if the M1 was unfavorable or favorable. Another way to look at it, if the number is positive and increasing the taxable income, then it would be an unfavorable adjustment. If it is decreasing the taxable income, then it will be a favorable adjustment. When we're talking about unfavorable and favorable M1s, unfavorable M1s, they reduce the expense or they increase income for tax purposes, and for favorable, they reduce the income or increase the expense for tax purposes. I always find that looking at the number itself If it's a positive, an increasing taxable income is unfavorable. If it's negative and it's decreasing taxable income is favorable. When you're decreasing the taxable income, that means you're going to be paying less taxes. Political contributions is an example of a permanent difference. So this is when the book income or expense is never recognized for tax purposes. So what does that exactly mean? It basically means that for book, you get that expense. For tax, you will never get that expense. So that's why it is called a permanent difference. There is no timing difference in this type of M1. Contrary, we have the temporary M1s. So with temporary M1s, we do have income and expense that is recognized in different years for both the book purposes as well as for tax purposes. So what does that exactly mean? It means that for over time, they will recognize the same amount of income or expense just over different time periods. So net, when you net it all together, you will see that there is no difference. It's just a timing difference. So unlike permanent differences, when the income and expense is never recognized for tax purposes, for temporary M1s, we do see that the income and expense is recognized, but in different years. So let's go ahead and take a look at depreciation. The reason why I chose depreciation is because this is very common in a lot of M1 work papers. Now, I won't go too much into the detail of how to figure out tax depreciation. For now, we're going to say that it comes from the tax report. However, in the future, I will be going over how to get this amount and how to check whether or not the tax depreciation the report is pulling is correct. So we will go over that in a different video. For book purposes, we have a depreciation number of $12,000. And this number is coming from the trial balance. It'll have its own line, and you just pull that number directly from the trial balance. Now let's look at the tax depreciation amount. So we looked at the book depreciation of $12,000, and now we went to the tax report, we double checked to make sure that it was correct, and then we get $14,000. How do we calculate this? Because we are looking at book as a starting point, we're actually going to use this formula here. We're going to take that book and we're going to subtract the tax depreciation. You can do this in multiple ways. Book is less than tax. So book is only saying that there's only $12,000 in depreciation, but for tax depreciation, the expense is greater by $2,000. Therefore, it's favorable by $2,000, the difference of book and tax. How we treat depreciation for book purposes is not always the same for tax purposes. And I will say here in this example, we're assuming that there is no bonus being taken for tax purposes. So at the very end, what do we have here? We have the final formula. The final formula goes like this. We have the book income plus or minus the permanent M1s plus or minus the temporary M1s to get us a taxable income. For companies that have multiple M1s, there's most likely going to be a summary schedule which summarizes all of the M1s. In this case, there's only 2, so that's not necessary. However, if you have multiple entities and you want to consolidate, in that case, it may be helpful to have a summary M1 schedule. As you can see, there is just a taxable income loss amount, but there is no tax rate. That is because when we are doing taxes, we don't use a flat rate. It is a gradual and progressive tax. So most likely the tax software that we're using is going to calculate it for us. Another thing that I do want to mention is the fact that we use this M1 schedule so that we can tie it to the tax return. As this is the first thing that we do the work papers first and then the return. So when you are doing the return, the preparer and reviewer refers to the schedule M1 to just double check that it ties to this work paper. So that's something to consider. So when you are looking at the taxable income and loss line of your return, to make sure that it ties back to this work paper. I hope you guys enjoyed this video and tutorial. If you did, don't forget to hit subscribe, and I'll catch you guys in the next one. Bye guys!